Every economic collapse looked rational until it wasn't. No one wakes up expecting the economy to collapse. Markets do not feel dangerous right before they fail. They feel normal, predictable, even responsible. In fact, the moments before disaster are often the moments when confidence is highest. When experts are calm, when warnings sound unnecessary. When the system appears to be working exactly as intended. History has shown this again and again. Not once, not twice, but every time. Because economic collapse rarely begins with panic, it begins with comfort. Markets don't feel dangerous right before they fail. When stability becomes a trap, in the late 1920s, the United States was convinced it had entered a new era. An era where growth was permanent and downturns belonged to the past. Factories were expanding, wages were rising. Stock prices climbed steadily year after year. The stock market was no longer seen as speculation, it was seen as participation. Ordinary families invested their savings, banks encouraged them. Buying stocks on margin was normalized, not criticized. Credit flowed freely because lending was profitable and defaults were rare. We remove buffers, we compress margins. We assume continuity because redundancy looks wasteful until it isn't. Every decision made sense in isolation. The system rewarded optimism. No one called it risky. They called it efficient. It punished caution. Few questioned whether prices could fall, not because people were foolish, but because recent history had trained them not to. Stability itself had become evidence that stability would continue. But beneath that calm surface, the system was becoming fragile. Not through fraud or conspiracy, but through alignment. Too many institutions, too many households, and too much capital were exposed to the same assumption. That assumption would soon break. When the system starts to eat itself, on October 29, 1929, the illusion collapsed. Prices fell sharply, then faster, then uncontrollably. Panic spread not because people suddenly became irrational, but because rational exits disappeared. Selling early meant survival, waiting meant ruin. Banks that had invested heavily in the market failed within days. Depositors rushed to withdraw their savings, only to discover that the money no longer existed. Businesses lost access to credit, workers lost jobs, demand collapsed. Unemployment reached 25%. What followed was not just a recession, it was a systemic breakdown. Production halted, trade contracted, confidence evaporated. And the damage did not stop at America's borders. Global trade collapsed as nations raised tariffs to protect themselves, suffocating the very system they depended on. The Great Depression did not happen because people ignored risk. It happened because risk had been normalized. Dependence mislabeled as efficiency. Decades later, a different system made a similar mistake. By the early 1970s, industrialized nations had built their economies around cheap oil. It powered factories, transportation, agriculture, and growth itself. This dependence was rarely questioned because it worked. Cheap energy felt like progress, reliance felt like efficiency. Then, in 1973, oil became a weapon. When Arab oil producers imposed an embargo, supply tightened overnight. Prices did not rise gradually, they exploded. Oil jumped from $3 a barrel to nearly $12. Gas stations emptied, lines stretched for blocks. Inflation surged, growth stalled, jobs disappeared. Economists struggled to explain what was happening. Traditional models did not account for stagnation and inflation occurring together. A phenomenon once considered impossible had arrived. Stagflation was not caused by a lack of intelligence. It was caused by a lack of resilience. The system had optimized for cheap energy, not secure energy. When the assumption failed, the consequences were immediate and global, but in the shadows, an unseen threat was spreading, one that would bring markets to their knees faster than ever before. When complexity hid the danger, the early 2000s introduced a new illusion. This time, it was financial engineering. Banks promised that risk could be sliced, diversified, and neutralized. Mortgages were bundled into securities. Securities were packaged into more complex instruments. Credit rating agencies labeled them safe. Few understood how these products worked. Fewer needed to. Trust replaced comprehension. Housing prices rose steadily, defaults remained low. The system appeared stable, profitable, and sophisticated. Warning signs were dismissed as pessimism. Liquidity flooded financial assets, small businesses disappeared. But complexity had not eliminated risk, it had obscured it. When housing prices peaked and began to fall, the structure collapsed from within. Defaults surged, securities once considered safe became toxic overnight. In 2008, the collapse of Lehman Brothers shattered trust completely. Banks stopped lending, not because they lacked money, but because they no longer knew who was exposed. The financial system froze, trillions vanished. Governments intervened with unprecedented bailouts, interest rates fell to zero. Confidence was restored artificially, but the damage was real. Homes were lost, jobs disappeared, savings evaporated. The crisis exposed a truth many preferred not to see. Complex systems can fail suddenly, precisely because no one fully understands them. Speed as a new form of risk. In 2020, collapse arrived faster than ever before. The economy entered the year strong, markets reached record highs. Optimism was widespread, then a virus spread. What began as a distant health concern became a global emergency within weeks. Entire economies shut down, supply chains froze. Fear moved faster than any financial model. Markets collapsed in days. The Dow Jones suffered its worst drops in history. Oil prices crashed, liquidity evaporated. But unlike previous crises, the recovery in markets was almost immediate. Governments injected trillions, central banks flooded the system with support. Stocks rebounded at record speed, Main Street did not. Small businesses collapsed, inequality widened. The divide between financial markets and the real economy became impossible to ignore. Markets had not recovered because the economy healed. They recovered because support arrived. The system survived, but the cost was unevenly distributed. The pattern that refuses to die. Across every collapse, the pattern is the same. The system did not fail because people broke the rules, it failed because people followed them. Each crisis was built on incentives that made sense locally but created fragility globally. Efficiency replaced resilience, growth replaced caution. Stability replaced skepticism. No villain was required, just alignment. Modern economies are not designed to withstand shock. They are designed to maximize output, minimize waste, and assume continuity. Redundancy is removed, buffers are eliminated. Risk is tolerated until it is no longer visible. And when the assumption breaks, collapse feels sudden, even though it was years in the making. History does not repeat because lessons are forgotten. It repeats because incentives remain unchanged. The next collapse will not announce itself. It will arrive quietly, wrapped in confidence. The question is not whether another crisis will come. The question is whether we will recognize it while everything still feels normal.